Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. All right, we're back. Episode 160. Hopefully, Sonu, everyone got to join us on Friday for the special Halloween live stream. I still have him. My Angry Bear on the YouTube channel. You can see my buddy, the Angry Bear. That was a lot of fun with Warren Pies and Joe Fahmy. And you were throwing money around. Is Skelly? No, Skelly's gone. Skelly is gone. I don't see him anymore.
Yes. He's retired for the year. So
yeah. Okay.
Now he's back in, and now we're just going through candy every single day. It's just amazing how much of candy is in the house. My kid's birthday was at the early part of October. Yep. Since then, and then we had Diwali sweets, and then Halloween. I need to just stop eating. Mm-hmm. How are you guys doing?
No, we're good. I mean, I do the same thing with the candy. We just get rid of it because it's just I don't know. I turn around, my boys just have it. Usually there's like a dog that goes upstairs and works its way to the closet. What are you doing in the closet? And of course, someone stashed away like 6 pounds of candy, and the dog is trying to get it. So that usually happens.
I came down to my office this morning. My closet doors in the office are completely open, and then I was like, okay, it has to be the kids. Right. And you know what they're looking for. Because they had like, I don't know, 100, 200 pieces of candy. And we're like, I was joking on Twitter that this is our opportunity to teach the kids about taxes, right? 2 pieces of candy for you, 3 pieces for me, 2 pieces for you, 3 for me. And they obviously are like, okay, mom and dad are not eating all of it immediately. They're hiding it. So they come into the office, the closet door is wide open, but the candy wasn't there. So they didn't get it. But anyway, the hunt is on.
The hunt is on. It's somewhere in your house is the good stuff. But let's just kind of dive in. I mean, there's so much to talk about. You and I have got a big script. We had trouble even come up with much of a title because there's so many different things we want to talk about this week. But let's just maybe go with the momentum that's out there, right? S&P 500 up 6 months in a row. We hit 8 all-time highs in October, one of the most we've ever seen the month of October. I'll turn to you in a second, Sonu. I've said this before, but I think October's job is to scare people. We came into the month with the government shutdown, which, by the way, when most people listen to this, we're probably going to have a record government shutdown, longest ever. We had, is Trump going to meet with President Xi? We had some worries of regional banks over BDCs, over those things. And then you look up and the market rallied. I know we're a little weak today on Tuesday. I'm not super concerned by that. What's your take on kind of the strength of this rally and where that leadership's come from? I know you and I did a morning call just yesterday with our advisors, our partners at Carson, and you talked about some of those things.
It's massive. I mean, the 6-month rally, David, we can put that chart up. So I looked at historical 6-month returns, right?
Yes.
All 6-month returns, rolling 6-month returns for the S&P 500 since 1950. And over the last 6 months, the S&P 500 without dividends, gained about just under 23%, 22.8%. That is in the top 4% of all historical 6-month returns, right? Wow. And you think, the immediate thought, of course, this is a rebound after what happened in April. But actually, the rebound happened in April, right? The S&P 500 hit a peak, prior peak was like February 19, something like that. And then by March 30th, it was down about 8.5%. Then you had Liberation Day. The index was down almost 19%. Below that February peak. And then the White House reversed a bunch of its tariffs, things like that. The S&P 500 rallied. And then by the end of April, it was down only 9% from its February peak. So the May to October rally, I don't know, you could disagree, Ryan, or maybe agree. I don't think it was just a rebound from the lows, right? I think it was more than that, right? And the good news is what comes after 6-month rallies of at least 20% or more, right. Looking at the historical data, 3 months ahead, median return 3.5%, positive 75% of the time. 6 months ahead, median return 4.8%, close to 5%, positive about 73% of the time. 12 months ahead, median return close to 10%, positive close to 80% of the time. Momentum begets momentum. Momentum's a powerful thing. What can you say?
Yeah, and all those numbers you just mentioned are all a little bit better than the at any time average return. So, and again, so we just had sell and may go away the worst 6 months. We pushed back extensively against that, saying, listen, I mean, we were one of the very few places the third week of April that said the lows were in. We started to see some extreme buying thrusts. Different things took place. We said, that's it. This rally is real, and we're going to see a surprise summer rally. You tend to see summer rallies in post-election years. You tend to see weakness the first or second quarter. So in a way, some of these things played out. But Sonu, the S&P 500 was up nearly 23%, like you just said, during the worst 6 months of the year on average. It really is. And we can actually share this one, David, the one about the best 6 months of the year are here. So we left the worst 6 months, and now the best 6 months are coming up 7% on average higher. What is it, Sonu? 76% of the time. Yeah, 76% of the time. But what was fascinating to me was, again, this is the best sell and make away ever. Looking at the 10 strongest periods of the sell and make go away, so really good returns like this one. The next 6 months were higher 9 out of 10 times, up like 14% on average. So double the 7% you tend to see during these next strong 6 months. Long-winded way of saying momentum is a powerful thing, something to be very aware of. And the other stuff, and I'll go to you in a second, Sonu, November is the best month since 1950 on average. It is the second best month the last 20 years. It is the best month the last 10 years, and the third best month during a post-election year. Of course, we are up 6 months in a row heading into it. So one of these days we're going to have some weakness. I think big fan of Tom Lee, obviously fun strat. He was on CNBC yesterday, and I agreed with most of what he said. He said maybe we're due for some choppiness the first 2 weeks of this November. I don't disagree.
Is that historically choppy, Ryan?
It can be. Yeah, it can be. And then you get that rally around the holidays. And that is exactly kind of what you can potentially see. Yes, market breadth, which I want to dive a little bit more into. There are some signs of a little bit of weakening. Nothing major, no major cracks after a huge rally. Maybe we're just due for some volatility. So what else from the market's point of view do we want to talk about here?
Actually, I want to get into breadth, but I'll lead you into it. Okay. So if you asked about what was driving this rally, it was basically tech. And I think initially it wasn't tech. I don't think it was tech in May and June and July, but August, September, October, it's certainly tech. And then if you look at the S&P 500 technology index, it was up 44% last 6 months. Every other sector underperformed the S&P 500. Now, consumer discretionary and communication services, which is sort of pseudo tech, that was also very close to the S&P 500, but everything else was, way below the S&P 500. Financials up 8%, healthcare 4%, utilities 15%. Now you can argue utilities is sort of a tech play, AI play right now. But yeah, the Magnificent Seven, right? May through October, NVIDIA, Ryan, was up 86%. Google's up 74%. Microsoft's up 32%. Apple, which is sort of left for the dead, Apple's up 28%. And Tesla is up 56%. So yeah, it was a tech story. And then you look at the style box, right? Like mid caps, small caps. And I always say equal weight S&P 500 is a proxy for mid caps. The equal weight S&P 500 during this period, last 6 months, S&P 500 gained 28%. Equal weight was up just 12%. The Russell mid cap index was up less than 15%, right? So that tracks. But it's not like everything else was negative. It was underperformed, right? It's still good. Mid caps are making new highs. Small caps are making new highs. But anyway, you go with that.
Well, there's a lot there. Our friend Jeff DeGraff over at RenMax summed it up best. And I'm just going to read what Jeff had to say about this, because we're hearing things called the Hindenburg omen. Meaning there's a handful of stocks making 52-week highs and a handful of stocks making 52-week lows. The theory goes that takes place at major market peaks. Let me just tell you something. If you bought the S&P 500 the last 15 years, every time you heard the word Hindenburg omen, you're doing really well. All right. I mean, I'm just going to put that out there. My favorite story, I think I talked about this last week in the podcast, but the gentleman who created the Hindenburg omen, he's since passed away, but he's blind. And there's a Wall Street Journal article of him talking about how he created this indicator, and he's literally like shooting his gun. So take that for what you want. That always caught my attention.
I need to look that up.
It's you can't make it up. All right, so here's Jeff DeGraff over at RenMac talking about there is some weakening but things are still good enough. This is straight from Jeff's research. If the Russell 2000's in an uptrend, it's safe to say that the breadth figures are decent. If the equal weight S&P is an uptrend, safe to say breadth is quote unquote good enough. That said, we fully admit that percent of issues above the 2-day moving average has been contracting as the market continues to go higher. And that could add some tension. And he says, but every good script needs tension. And I think that's a really simplistic way to put it, but sometimes that's powerful because the Russell 2000 just closed at the highest monthly level in the history of the Russell 2000 just a couple days ago in October. Oh, by the way, so did NASDAQ 100, so did the Dow, so did the S&P 500, so did majority of the rest of the world from stock markets and equity markets across the globe. So we can nitpick things all we want. And again, maybe when you see the gains since the April lows, majority of that was tech. Well, apologies. Tech was like the leader and one of the few areas to outperform the market. That's not perfect, but it's why we've been saying you probably want to make sure you're at least equal weight tech, if not a tad overweight tech, like we are in the models we run. So again, you can pick holes in it. Just I hear the word Hindenburg open, and I don't get too worried. In fact, I take the opposite approach of maybe we should think about staying overweight equities like we are. Maybe I'm wrong, but I'll turn to you in a second. I want to see more weakness out of advanced decline lines. We've seen some weakness in the last 2 weeks, nothing major. Yes, there's been this big divergence last week where tech was up a bunch and equal weight S&P 500 didn't do as well. We just talked about what, like a record 6-month rally. Maybe we're due for some weakness potentially. Much like that weakness we saw in October, though, it was bought up aggressively. We had that 3% drop, I don't know, 3-4 Fridays ago. Everybody bought it up. Why? Because as we pointed out and other people have, like 82% of fund managers are missing their benchmark or underperforming their benchmark this year. Any weakness is probably going to be a buying opportunity. Sonu, do you like slingshots? Did you play with slingshots as a child?
I do like catapults and slingshots. So I like watching movies with those big catapults and, basically like your Game of Thrones, old school battles, right? Game of Thrones, things like that. These period movies which have these massive catapults and slingshots. So yes.
Well, that's good. That was not a short answer. Sonu, that was the opposite of a short answer. Actually, that was a very long answer if you like catapults. Anyway, but a fun one. David, we can put this up on the YouTube channel. I say the slingshot says don't sleep on 2026. So at the lows this year, the SP was down more than 15% on a closing basis back on April 8th, I believe is when that was. Sonu, now we're probably, I know the year's not over, we get it, but let's assume, right? We're up 16, 17% price return. Let's assume we finish up double digits, which knock on wood, we think is probably going to be the case here. Only 3 other years in history. Do you notice I just, on the YouTube channel, I held up a 2? I held up 2, and I said only 3. So that tells you I'm not 100% with it this morning. Only 3 other times in history, 82, 2009 and 2020 saw a year down 15%. Of course, obviously that was early in the year, but then rallied up to double digits. The next year is what I really want to focus on. So that would be 2026 in this particular case. 1983, the stock market's up 17%. In 2010, up another 13%. And in 2021, up 27%. So that's just one stat. I get it. But I think the slingshot, the momentum, the catapult, whatever we want to call it, is real. And when you look at, and I get it, like people go crazy on Twitter, well, sample size of 3. Listen, yes, it is only a sample size of 3, but at the same time, you're looking at the whole year. You're looking at a lot of things that really took place in there. So I would not want to ignore this upward bias we've been in, well, honestly, for years, but more specifically, the last 6 months. I think it says 2026 is probably going to be a little bit better than average. I get it's a midterm year. We have a new Fed chairperson. Those aren't usually great. They cause volatility. We're going to talk more about outlook over the coming weeks and months. Still pretty optimistic, though. The slingshot is something you don't want to ignore. What do you want to add or what do you want to talk about?
Look, I think the theme is don't sleep on momentum. Yeah. That's the title for you. Don't sleep on momentum.
Maybe that's what we'll call this. Maybe that's what we'll call it. There, David, write that down. Episode 160, don't sleep on momentum. We knew we'd get there eventually. Yeah.
But look, I think that momentum story, by the way, we just said the equal weight S&P 500 over the last 6 months underperformed, but by positive 12% return in 6 months is not a bad thing last I looked. No. Right?
Yeah.
And then you look abroad, same thing. David, we can put that chart of index returns over the last 6 months. So May through October, right? S&P 500 up total return 23.5%. The MSCI EFA index tracking developed markets, that's up 13%. It's well below the S&P 500, but it came into the year much stronger than the S&P 500. It's up about 19. It's up actually about 27% year to date, right?
Okay.
So that's pretty good. Now, EM had a 6-month return of 27%.
Okay.
Right. And so that goes back into the tech story is not just a US story. It's playing abroad as well. And EM was mostly driven by 3 countries, Ryan. South Korea. The MSCI South Korea index was up 75%. Wow. Technology has a weight of 45, 50% in the South Korea index. Taiwan up 55%. One company, TSMC, which makes chips, obviously, makes up 25% of the basket. Technology makes up 70% of the Taiwan basket. China was up 24%. Technology and communications makes up about a third of the Chinese basket, the MSCI China index, right? Okay. And these 3 countries, China, Taiwan, South Korea, make up about 60, 62% of the MSCI EM index. So you have that tech story playing out abroad as well. But then you have other countries too doing well. South Africa, by the way, was up 33%. That's a metals and mining and materials and gold story, right? Mexico was up 20%. Japan was up 18%. Singapore, 18%. Brazil, 18%. So all this to say, there's a lot of momentum. It's not, yes, tech is a big story, but it's not just that.
Well said there. I think year to date, at least as of Friday, 10 sectors are up on the year. Staples were negative. And if you told me what sector do I want to see underperforming across the board on a relative basis, it's staples. Because once staples starts to outperform, is maybe a warning sign. Like all of a sudden, healthcare is starting to get a little bit better, but look what's leading healthcare. It's biotech, right? So it's like, okay, that's a little more aggressive type of area potentially. You know, speaking of momentum, Sonu, S&P 500 has been higher the last 9 Mondays in a row. That's like the 4th longest ever. I've got theories. You've got theories. I thought you summed it up pretty well. We're in a news-driven market. It's like bad news comes out on Thursday or Friday evening. And then over the weekend, things kind of calm down. Then we pop on Monday. I mean, it is what it is. Mondays have been strong this whole year, to be honest. But lately, do you think it's just we're more of a news-driven market and news happens on the weekend? Or should I say better news happens on the weekend?
Yeah, good news happens on Sunday, bad news happens on Friday evening.
You are clearly not a Bengals fan because there's no such thing, Sonu. We have literally the worst defense in the history of the NFL. There are 6, the rumor is there are 6 high schools with a better defense than the Bengals in the city of Cincinnati. I'm not disagreeing with it.
So you brought that up on the Monday call we do with our partners. And so I don't watch football. I keep track of scores, but then I went back and saw the last 2 minutes. The replay. I was just blown away. I was like, this is crazy. This is not like I saw the score. I was like, wait a minute, they lose? And I guess they did.
Yeah.
Sorry, brother.
In the history of the NFL, only 2 teams ever have lost consecutive weeks scoring 38 points or more. The Jets in 1966 and the Bengals right now. So go figure.
What happens next? Do they win?
I mean, you know what? So here's, we don't need to say much more than this. They're on a bye, and the over-under for the defense giving up points is 47 points on their bye weekend. So we'll just see. We'll see. All right. Where were we?
We were talking about momentum. So I'll connect this to the economy, and then we can do Fed, whatever you want to do.
Yep.
I feel like this momentum and this bifurcation of like people are saying, oh, there's no breadth. That's kind of leading to poor macro analysis for the economy too. They're like, oh, the market's like K-shaped, right? Some things are going down. It's really not. Like I said, it's still positive, but it's really just the Mag 7 and things like that. And then people are like, oh, it's the same thing in the economy, right? The top income levels are doing really well. Wealthy people are doing well. And everyone else is like having a horrible time, right? I feel like that's just an excuse for people to say, like, oh, we're bullish, and that's being driven by these few companies and these few wealthy people, and everything else is really bad. Look, if everything is really bad, the aggregate economy would be doing 0% GDP growth. We're closer to 2% GDP growth. We're not 3% like we did in 2023 and 2024. Right. Definitely slower than that, but it's not that bad. I mean, like you hear people talk, it's like, oh, things are really terrible. And then you look at what's happening in earnings, Ryan, right? Profits wouldn't be rising if the aggregate economy was really, poor, especially for people below 60th or 70th income percentile, right? Which is what people say, oh, it's a K-shaped economy. Look, profits are made up of profit growth made up of two things: sales growth, margin expansion. Margin expansion, which is happening. That tells you how, good companies are at adapting to different things like that, operating leverage, all of that. But sales growth, where does sales growth come from? The economy. If the economy is not doing great, you don't get sales growth. Sorry, right? And that gets to even the stock market, right? People say, oh yeah, the tech, it's always just going to be tech. But these tech companies, you take Google and Meta, things like that, a lot of their revenue is from ad sales, right? Ad sales, last I looked, is the most cyclical thing, right? You would say semis, right? Semis are traditionally cyclical.
Oh, yeah.
Consumer discretionary, very cyclical. So if the aggregate economy are doing badly, or if you're close to a recession, we wouldn't see this, outperformance, even from, technology companies, consumer discretionary, semis, things like that, right? We wouldn't see earnings across the board coming in solid.
Well, I mean, Ford blew out, just stock soared. 3M, the Caterpillar's turned itself into an AI play, apparently. It's across the board. This has been an incredibly strong earnings season. We've talked about this. More than 80% of companies beat on revenue and on earnings, and earnings growth expectations for the full year keep increasing, and for the third quarter. Now we're up over double digits year over year, third quarter expected earnings. That'll be 4 quarters in a row we've seen that. Got to go back a couple of years ago. The last time we saw that, it's as simple as earnings drive long-term stock gains, and the economy is not perfect. The housing market is weak. We understand that. Small businesses are still struggling with some of the higher interest rates. We understand that. The labor market, there are cracks. There are some layoffs that are coming out there. We talked about that before, but the truth, again, the economy is still growing about trend, and that's a positive. I wanted to talk about earnings. Anything else you want to talk about on markets before we go to something else? I don't think there's anything else I wanted to touch on. Maybe, I love this quote from President Trump, because he's got some good quotes. On a scale of 1 to 10, his meeting with President Xi was a 12. Isn't that the most President Trump quote ever? Yeah. And by the way, you can actually leave comments on the YouTube channel. That is the magic elixir to the whole thing. So feel free and leave a comment on the YouTube channel. We'd greatly appreciate it. I mean, we talked a lot about this. It seemed like most of the news, Sonu, was out before Thursday when they got together and shook hands and took some pictures in front of the flags. What'd you find high level on what was said at the honestly fairly positive, get it out of the way, okay, now we're best friends again for at least 6 months or a year, whatever it is, type of deal we just had with China there?
I think that's a big picture. I think it was 3 months ago, sometime in July, I wrote a piece saying the trade war is over.
Yeah, you did. Yeah.
Based on everything they were saying. And, I think the market actually is it's not like I came up with anything new. The market had sort of sussed that out back in May. Mm-hmm. The market figured out this whole thing is, we're done with this, right? Yeah. Look, if we had 145% tariffs on China, and if that was going to stick, I would say the market would be in trouble. But the market figured out that's not going to stick. In fact, it's not going to come back. And look, both sides escalated recently. Mm-hmm. We've talked about it over the last few weeks. The strategy on both sides was escalate, but I think the goal was de-escalation. And ultimately what we got was de-escalation. Mm-hmm. Right. Yeah. I don't think it shouldn't have been a surprise to see both sides pull back. No, I don't think I would call it a deal, but you need something like this to build trust between the two sides. Right. There's a lot of distrust, I think, with good reason. Sure. And you have to take some de-escalation steps, temporary, but at least we got a 1-year reprieve, and you'll see where things go from here. But let's talk about what the two sides sort of gave up, right? Because that's the frame in which everyone's working here. It's like, what did the US give up? What did China give up? Who won? I don't think neither side quite won. I think both sides won in the sense that hopefully we don't have to deal with this for another year. Right? I mean, that's how I'm thinking about it. But China, they suspended their latest set of rare earth export controls. Now, there's something interesting here. People are like, they rolled everything back. They didn't. In April, they put a whole bunch of rare earth export controls. And then in October, 3 weeks back, they put some more, right? Really strict ones. They've rolled back the controls they put in October. They did not roll back the ones they put in April. That's in place. Now, so in addition to that, they will take, in quotes, strong actions on fentanyl or the chemicals that are used to make fentanyl. We'll see, right? That's one of these trust building things. Like, you need to verify what they're doing. And then obviously this mattered to President Trump and farmers. They're going to resume soybean purchases, right? They're going to buy another 12 million tons this season, right? And for the next 3 years annually, they're going to buy 25 million tons, right?
Didn't they say that, though, back in like 2018, then they didn't? Or am I wrong with that? I thought they said some of the stuff they're supposed to buy, they never really did.
Yes, so they did buy for a little while. In 2018, actually, they pulled the same thing. It's like, you would think the U.S. would learn, like, okay, they keep taking the same hostage, so let's not give them the hostage, right? And the hostage right now, or since 2018, one big hostage has been soybeans, right? So we've seen this movie before, and then they come to the table like, oh, we'll buy back soybeans, right? So in 2018, they pulled back. 2019, they didn't buy any. But actually, 2020, 2021, 2022, 23, 24, they bought on average about 25 to 30 million tons of soybeans. I'm just looking at a chart. So it's not like I know that off the top of my head. I have the numbers next to me. And they're saying, okay, for the next 3 years, we're going to buy something similar, right? So basically, China pulled back from recent actions that, escalated everything. And on the U.S. side, they paused something called this 50% rule. They implemented, the Commerce Department implemented at the end of September. Basically, it would have added more Chinese firms to the U.S. government blacklist, right? Including firms that have 50% ownership by other Chinese firms that are already on the blacklist. So this would have been a big deal. That's gone away. China's happy about that. The U.S. suspended port fees for Chinese ships as well. Now, China also suspended them for U.S. ships, but we don't have too many ships going there. It's all mostly Chinese ships going back and forth, right? So that was a big deal for China. The big one, obviously, the U.S. dropped fentanyl tariffs by 10%. Back in February and March, they increased the tariffs because they weren't doing enough on fentanyl. President Trump put a 20% fentanyl tariff on them. And that took statutory tariffs. By statutory tariffs, I mean announced tariffs, right? Total tariffs on Chinese imports is about 57%. With the drop, it came down to 47%. But here's the thing. This is where it gets really confusing. That 47% includes what was already in place from the first trade war in 2018, 2019, right? And that was about, let's say, 25% or thereabouts. So the additional tariffs this year, let's say trade war 2.0, is about 22% right now. Remember, this is all statutory, what's announced, right? In reality, we've got a lot of exemptions. iPhones, for example, are not tariffs. Electronics, laptops, desktops, all this stuff, not tariff, right? So despite 57% announced or statutory tariffs on Chinese imports, the effective tariff rate, right, what they're actually paying based on imports coming in, is about 28%, right? Okay. And now Trump has dropped that, by 10%. So that 28 maybe goes down to 18, 20%, something like that. But here's the thing. Other Southeast Asian countries have those same level of tariffs. Before this, when he came into this year, countries like South Korea, Vietnam, all of that didn't have any tariffs on them. Now they have about 20, 25% tariffs. So now China and all these other countries are sort of on par, right? Which is the irony of this whole thing. I thought we were ganging up against China with everyone. But anyway, it is what it is. Right. From a market perspective, I think we're in a good position because hopefully we don't have to worry about this for a year.
Well, that's kind of sums it all up there, that maybe we've kicked the can, as they say, for some of this. I did see some other highlights is what I'm going to call this. President Trump is set to visit China in April of 2026. And then President Xi is set to visit the U.S., quote unquote, soon. So,
hopefully we have a reprieve at least till April because, they're not going to want to screw that up.
Exactly. And I mean, listen, we'll talk a lot about this. It is a midterm year, right? There's politics do play a game in this. Yes, historically, you know what happens in midterm years. This is political. It's just fact. The party that won the U.S. election tends to lose seats. So there's this kind of what's going to happen with the election. It's not a coincidence. You tend to get major market bottoms in October of midterm years in 2022. And everybody told us how bad it was. Everybody told us a recession's coming. We said, no, not so sure about that. And just from a pure cycles point of view, it was a picture perfect bear market bottom in October of a midterm year. No, we don't see a bear market next year. If it happens, we'll let you know. But the reality is that's kind of how these things shake out. So the other thing, Sonu, I wanted to touch on just briefly, because we'll finish with the Fed. The government shutdown, we did kind of talk about it. The day you and I are recording is day 35. Tomorrow, which is Wednesday, when most people hopefully listen to this podcast, will be 36. That'll top the all-time record, which is just the last one, which lasted 35 days. So this is 2 in a row. It is what it is. The market, as of, I guess it would be Monday's close, the S&P 500 was up 2.3% during those 35 days. So we said repeatedly, hey, it is what it is. Markets take these in stride. Most people understand. November 4, Libby Cantrell over at PIMCO, amazing work. She pointed out November 14th is a day that a lot of service people in the Army and in the military are supposed to get paid. So listen, when you stop potentially not paying them, that's when this stuff gets real. She thinks there's a good chance we'll have this all signed, sealed, and delivered by Thanksgiving. And as someone who's going to travel to New York City this week and then actually out of the country next week, I am worried when I see 3 to 4 hour waits at some of these TSAs, like in Houston. Now, I have Clear. Clear is not the U.S. government. Clear apparently is a private company, just saying, once again,
and this
that's
is not
good.
An endorsement, by the way.
That's not an endorsement. I don't think they're probably traded, but listen, but I am worried about, someone who's supposed to fly here the next couple of weeks. When you hear and see some of the lines at TSA, that's going to get, listen, you might vote blue, you might vote red. Nobody wants to go to an airport and wait for 3 hours to go through TSA. Let's hope we're getting close, but we are going to have a record. I'm just kind of ranting a little bit. I'll update everybody next week on how my travels were. Hopefully Clear saves me, because I am flying into where am I going? Newark. I'm going to Newark, and they're saying it's a couple hour waits at the standard TSA lines. Hopefully Clear saves me. What do you think about the shutdown? And let's talk about the Fed.
So I have some international travel coming up in let's say 16 days. No, 15 days. So hopefully it's all in. So here's my thing. I know Libby said Libby's targeting before Thanksgiving. So that's at least 2 more weeks. I think this is done next week.
Good.
I've been in the camp. I not that I have any inside information. I don't. I have not. This is my, let's say, educated guess. It's a guess, right? I think this ends next week. I look at the signs. I follow a few political reporters up on the Hill. There's some active discussions, meaningful discussions within the Senate. Obviously, the Senate is what needs to pass, a continuing resolution to fund the government. And then the House will sign it. Trump will obviously, sign it. So Trump will get involved. If Trump gets involved, the House is going to pass it, right? So it's really what happens in the Senate. But I've always thought today, November 4th, we have a bunch of elections around the country. Virginia, New Jersey, New York. And one party or the other is going to get a message. And I thought that will be the forcing function to let's get this done with.
Yeah.
Right.
Okay.
Even, way back in late September, early October, I was like, now, this may go up till November 4th and not much longer.
And you said that a month ago, like literally a month ago, you pointed out, I was like, I don't know about that. But I will say some of those betting markets, which have been, kind of a nice place to get some information, especially in a world where you're not getting as much information because the government shut down. They were saying at the very beginning, this shutdown was going to last a lot longer than maybe expected. And sure enough, here we are. All right, so let's kind of wrap it up. I mean, I've got maybe 10 minutes or so, Sonu. We can talk about the Fed. So the Fed came out. They cut interest rates widely expected. It was said that it was a little hawkish, though, because during the Q&A, Powell kind of pushed back on just the near, I think it was 91% chance of a Fed cut before the meeting. A December cut, sorry. And he kind of pushed back. Now, those odds down to 60, 65, and that's where they were on Friday and kind of where they still are. Market kind of took it in stride. I know there's a little bit of a sell-off. I think short-term yields did a little bit of a pop. Small caps have underperformed. We like large over small, so we were not shocked by that. What's your couple big takeaways from the Fed here?
Big picture, look, we've been positive, right? I am very positive, and you are too. We have momentum, positive seasonality for this next 2-3 months, call it.
Okay.
Right. We have fiscal stimulus, like tax refunds in the first half of next year. So that'll be positive. I think the trade war thing is behind us, hopefully for a good long time. So these are all tailwinds, right? And I think a dovish Fed, I would put in there as a tailwind as well. Now, what could sort of, I was going to use a phrase. I shouldn't, since this is, a family podcast. But, I don't know how many families listen.
Mess it up. Want to say that?
I was going to say, no, I won't say it. But the Fed came in. The risk is the Fed is not as dovish as expected. The Fed comes in as hawkish. Now, I don't think that lasts, because I think this is a temporary thing. By next year, Powell may be out, and then we get Trump's Fed, right? One way or the other. But anyway, going into this meeting, the expectation was they're going to cut 25 basis points, 0.25 percentage points. They did. The target Fed funds rate is now in that 3.75 to 4% range. They've cut, Ryan, by 1.5 percentage points since the peak of interest rates in the cycle, 150 basis points. That is the largest set of cuts we've seen outside of a recession since the mid-1980s. Even in that 95 to 97 period, Greenspan cut rates by about 125 basis
125.
Points.
Okay.
Right.
Okay.
We are above that. So all else equal, that is huge, right? The Fed cutting by 150 basis points over the course of 2 years, thereabouts, let's say less than 2 years. That's a big deal, right? Now, the Fed is acknowledging that, yes, they've got a problem with both sides of their mandate. The labor market is cooling, but inflation's elevated. But Powell sort of poo-pooed inflation. He's like, and I think that's part of the reason. I don't think inflation's. I think inflation's still a problem. I'll put it that way. I think inflation's a problem, but Powell saying inflation's not a problem. He's like, oh, goods inflation, one-time impact. Okay, fine. Housing disinflation, that's happening. That's a good thing. Now, core service inflation, I would say the Fed's got a problem there. It's elevated, but Powell says, oh, that's mostly because of the stock market, things like that. I think it's more than that, but whatever. It's what Powell says that matters. He's saying inflation, once you take out core goods, once you take out these things like stock prices, financial services, all of that. Once you take out food, once you take out energy, once you take out life.
Take it all out. Take all the bad stuff out.
Then we don't have inflation. We don't have an inflation problem. But I think that's dovish, right? If the Fed governor is saying, you know what, we're cutting rates, inflation's not a problem, even as inflation's pretty much close to 3%, that's very dovish. And now the labor market is slowing, and that's essentially why they're cutting rates. They're worried about the labor market, but I think there are enough people on the Fed right now that are worried about inflation. They're like, maybe we should pause. We don't have any data. When it's all foggy and cloudy and things like that, maybe let's just be careful. Let's not keep cutting. You could argue if you don't have data, what if things are getting worse and we should stay on that same trajectory of cutting? That is what Stephen Moran, the White House, he's like, he was placed on the Fed. It's like a bomb thrown into the middle of the Fed, right? So there were two dissents. 12 people, there are 19 members on the, Fed. 12 members vote. 10, it was a 10-2 vote, but we got two dissents in either direction. One was Stephen Moran. He's a former chair of the White House Council of Economic Advisors. He's currently on sort of loan from the White House. He wanted a 50 basis point cut. At least he was consistent with his dissent from this September. He wanted a 50 basis point cut even then. And then on the other side, you had the Kansas City Fed president, Jeff Schmidt, saying, I don't want to cut this meeting. And then on Friday, you had like Austin Goolsbee, you had Beth Hammock, Lori Logan from Dallas as well. I think Hammock's from Cleveland. No, they don't vote. And they came out and said, we don't think we should, we think we should pause on cuts here. So I think there's a good number of people. I don't know that it's a majority, though.
Right.
I think there's a significant minority on the Fed right now that wants to pause on cutting rates. But here's the thing. I don't think it matters. Next year, we're getting cuts.
Yeah, I'll chime in. I mean, this is anecdotal, and I do need to verify this, but just doing this long enough, it feels like the Fed always gives you a cut in December, right? I know 2015 was one cut, 2016 there was a cut late in the year, some other years. So maybe they just do it. Okay, we'll reevaluate. And it made sense. It gave Powell some cover. He knew the Q&A was going to be kind of tough, and it was. He had great answers. I will say, though, I forget what was going on that day, but I actually listened to the whole presser, and I was shocked, Sonu. So they pass this mic around everybody. How many people literally take the mic and immediately go, like,
don't do that, right?
Clear your throat. Like, it was like every person. They're all just coughing and phlegming and hacking into the mic. That I know, like, maybe we're not worried about COVID anymore, but I still don't like the idea of people coughing on a mic for the whole country to listen to. And then, I mean, they did it. I couldn't believe it. I can't listen to this. I was getting so mad. Like, I'll just read an AI printout later or whatever Powell said. It was so disappointing to how everyone just doesn't know how to hold a mic. So if you're listening and you do this, please do not cover.
And if you're invited to a press conference in front of Jay Powell.
Yeah, just don't cough into the mic, clear your throat, and then talk, okay? I don't even know where I was going with this. I've got one more thing. Yeah. It struck me because they did ask about AI in a bubble. Remember, maybe a month ago, he kind of gave a little bit more of a, well, maybe AI is a bubble kind of type of feel to his answer. He pushed back against that. He said these companies, and I love this quote, by the way. This is a quote directly from him. These companies have earnings and stuff like that. that was just his quote, not mine. I'm reading it word for word, is what he said. And then in the 1990s, they were ideas versus company. They were ideas rather than companies, what I was trying to say. So he had a good answer. He knew that question was coming. He pushed back against the AI bubble theme, I think, did fine. Because literally Thursday and Friday, those tech stocks did extremely well, mainly because of strong earnings, like we talked about, strong CapEx, like we talked about. Anything, I mean, has there ever been a time, though?
That's also dovish, right? Like,
I think so.
Look, if he's saying, if you're directly asking him, basically the premise of the question is, look, buddy, you're lowering interest rates. Yes. Are you going to accelerate this boom / bubble? And he's like, no, I don't think it is. Right? Yeah. Because he says AI investments, data centers, things like that, they're not interest rate sensitive, unlike other sectors of the economy. Okay. It's driven by longer run views and demand and things like that, AI workloads, stuff like that. Okay. And I think that's dovish. He's basically saying, no, we're not worried about that stuff. Right. Yes, I forget what I said 2 weeks ago, but we're not worried about it. We'll still cut.
Yeah, I gave my honest answer 2 weeks ago. I had time to think about this one. So has there been a time, though, where we've had dissensions, right? One dissension, we had two dissensions, but literally this time we had dissensions in opposite ways. One person saying cut, one person says you shouldn't have cut at all. Do you have a chance to look at that? I mean, we're talking decades, probably, right?
Decades. I mean, where it usually happens more often than not is on the Bank of England. Almost always. Every time they cut, there's somebody on one side, somebody on the other, and then the majority votes for the cut or, the stay put or whatever it is, right? Yeah. There's almost always somebody, like it happens quite often across the pond.
I didn't know that. That's pretty cool. Okay, it's good to know. Yeah. I've said I like fish and chips. I mean, who doesn't? Fish and chips. Simple meal. One of the best fish and chips I ever had was at some restaurant right across from the Lion King in London. We're talking 25 years ago. I still remember that. It was a tasty meal.
Oh, so I got to ask you, since you like fish and chips, ketchup or that tartar sauce?
Oh, well, both. I mean, I would use the ketchup for the chips and the tartar sauce for the fish. Yeah, I mean, that's I don't want to pick one. It's like when it's not like I eat McDonald's that often, but you get the chicken nuggets. Sometimes you just have to go to McDonald's with your kids, and it's like I get two dipping sauces.
Oh yeah, buffalo. Why not?
And the honey mustard. All right. Well, listen, I do. Speaking of kids, I've got kids in like a couple different basketball spots. I need to go drive some kids around for a minute. Any final comments, Sonu, as we wrap up episode 160?
Look, I think there are a lot of positive tailwinds, but one risk is that the Fed is more dovish, more hawkish than the market expects. It's always relative to market expectations. Powell didn't want to be pinned down to another cut in December, but look, the odds have come down for a December cut from over 90%, as you said, to below 70%, maybe it's 66, 67, something like that. Okay. But it's still above 50. Yeah. That's notable, despite this pushback. Right. Like I said, I think it's a significant minority. It is significant, but I think it's a minority. I think on balance, they probably cut. But even if they don't cut, I don't think it's a huge problem. By next year, we're getting a few more cuts. I think the Fed funds rate by this time next year is going to be closer to 3% than 4%. That's a tailwind. Okay.
Very interesting. No, it for sure is. So with all that, everyone, thank you. We've had some really good downloads, listens. Please, again, give some comments on YouTube. We really appreciate that. And I don't know. I guess with all that, I mean, I was not Angry Bear. Hold my guy up again. There's old Angry Bear. He's just so mad about how great everything is out there. That was my Halloween costume. We'll be back next week, everybody. We've got a really big guest coming up in a couple of weeks, around Thanksgiving time. Yeah. I don't know, around Thanksgiving.
Maybe 3 weeks. 3 weeks from now.
I think it's 3 weeks. Yeah, but you'll like it. You'll like it. But next week you do get Sonu and I again. And check out that live stream. The Halloween live stream was awesome. Definitely check that out if you have not had a chance yet. So with all that, everybody, we'll see you next time. Enjoy early November out there, and let's keep this momentum going. And I forget what the title was. You wrote it down, though, or hopefully David wrote it down. Whatever he came up with. Whatever. Something about momentum. Episode 160
don't
and the
sleep
books.
On momentum. Don't sleep on momentum.
There it is. Don't sleep on momentum. All right. Take care, everybody. See you next week. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.